Welcome back to Iron Financial. This is the explainer, where we aggressively cut through the macroeconomic noise to help you forge a stronger, completely resilient portfolio. I'm your lead analyst, and today we're tearing into a company that is actively trying to build an absolute fortress right in the middle of widespread market weakness. We are drilling down deep into Kimberly-Clark, ticker symbol KMB. We're looking at their Q1 2026 earnings. And honestly, at first glance, this consumer staples giant looks like they are pouring heavy concrete and laying down serious structural reinforcement in a tape that has been incredibly punishing to a lot of legacy brands out there. Hold on a second. I'm the market skeptic, and it is literally my job to ask if this so-called fortress you're hyping up is actually structurally sound, or if we are just looking at a fresh coat of paint slapped over a crumbling foundation. I mean, are we really supposed to believe that a legacy diaper and tissue company is the ultimate safe haven right now? Look at the macro fires burning all around us. Consumer credit is tightening up, there is a massive sector rotation out of defensive staples happening as we speak, and inflation remains incredibly, stubbornly high. So that is exactly the question we need to answer today. Is Kimberly-Clark an ironclad staple, or is it a classic, dangerous value trap? Because while you see a fortress, I see a company facing actual, literal supply chain fires. I see a company facing the looming, heavy threat of $100 a barrel oil. And I see a company undergoing a massive, highly risky, multi-billion-dollar acquisition. So is this company truly resilient, or are these flashy headline numbers just masking deep structural vulnerabilities that are absolutely going to crack under pressure? Look, that's a completely fair question, but the tape doesn't lie. When the market gets this volatile and this unpredictable, you want to see a balance sheet made of steel. You want durability. So let's stop theorizing and let's actually look at the foundation. Let's lay down the raw financials right out of the gate. For Q1 2026, Kimberly-Clark posted net sales of $4.16 billion. That is a solid, respectable 2.7% top-line growth. But here is the massive structural beam that immediately caught my eye. Operating profit jumped an absolutely massive 19.3% to $753 million. That is serious, undeniable margin expansion. They are squeezing out significantly more profit per dollar of sales, and that's being driven by lower overhead and just raw, brutal productivity. Okay, but do not ignore the bottom line there. All right? Adjusted EPS from continuing operations actually bled out. It dropped 1.2% to $1.60. If the operating profit is up almost 20% like you say, why is the actual earnings per share going backwards? Well, I'll tell you exactly why. The adjusted effective tax rate spiked from 20.7% to over 26%. Plus, they're eating $48 million in Kenvue deal costs alongside another $51 million in transformation charges. And let's just be brutally honest here, they had a $120 million insurance recovery that totally bailed out their headline earnings. Without that random cash injection, the adjusted operating EPS is heavily slipping. That is not the sign of an impenetrable fortress. Listen, EPS noise is entirely normal during a major multi-year restructuring phase. You can't get bogged down in the accounting friction. You have to look at the underlying operational strength, specifically how they performed against Wall Street's Zacks estimates. Because they didn't just beat the street, they completely ripped past the consensus. The analysts out there were projecting a consolidated volume impact of just 1.1%. Kimberly-Clark shattered that. They came in at 2.6%. Beating the street is great, sure, but let's look at exactly where that beat originated. I'll tell you where it originated. It originated from real sticky, undeniable demand. International personal care net sales hit $1.51 billion against an estimated $1.46 billion. Even North America beat estimates, coming in at $2.65 billion against the $2.64 estimate. This isn't just a clever accounting trick. This isn't an aggressive share buyback artificially propping up the numbers. They're moving substantially more physical units than the street thought was even possible in a highly constrained macroeconomic environment. That is what I call true load-bearing strength. And this dynamic brilliantly illustrates the core bull case right here. Organic sales were up 2.5%, but the real metric to watch, the absolute driver of long-term value, is the 3% volume plus mix growth. This is the 9th or 10th consecutive quarter they've posted gains here. Think about that consistency. They are selling more products, and crucially, they are selling higher margin products. Consumers are actively choosing their premium best-tier innovations regardless of the broader inflation hitting their wallets. Yeah, but you are completely ignoring the deliberate demolition happening on the other side of the ledger. There is a 1.8% sales drag right off the top from their exit of the U.S. private label diaper business. They are giving up market share and revenue intentionally. If you are literally shrinking parts of your core business just to protect your margins, that tells me the consumer is severely under pressure and the overall pie just isn't growing as fast as you'd like it to. No, you've got it backward. They are cutting away the rust. Private label is inherently low margin, right? And in an inflationary environment where commodity costs are rising, private label completely destroys your bottom line. Exiting that space to focus purely on premium branded goods like Huggies and Kotex, products where they have actual real pricing power, that is exactly how you forge a higher margin, substantially more durable portfolio. Just look at the segment breakdown to see what I mean. North America net sales actually declined slightly by 0.6%, which was heavily impacted by that deliberate private label exit we just discussed. But contrast that with international personal care, up an absolutely incredible 9.1% to $1.51 billion. Organic sales there were up 4%, and that was driven entirely by a massive 4.1% volume surge. They are capturing huge market share in emerging economies. When your domestic market is undergoing heavy renovation and you're busy cutting away the low-margin rust, you desperately need your international segment to step up and act as the steel beam holding up the ceiling. And that is exactly what the international segment is executing right now. Well, it's a good thing international is booming, because let's face it, a negative print in your home market is never a great look for a legacy U.S. staple, even if management swears up and down that it's all just part of the grand plan. And speaking of management's grand plan, that brings us directly to the corporate commentary. CEO Mike Hsu says, and I quote, "Our people are the power behind our Powering Care growth engine. They fuel our resilience." Look, I appreciate a good motivational quote as much as the next guy. It sounds great in a press release. But Wall Street doesn't run on motivational quotes. It runs on cold, hard cash flow and expanding margins. Powering Care growth engines do not pay out quarterly dividends, and they certainly don't service billions of dollars in corporate debt. It's incredibly easy to talk about resilience when you're standing safely behind a podium giving a heavily prepared speech. I need to see the actual operational efficiency. Show me the factory floor data. Is this just corporate hype, or is there real mortar holding these bricks together? Oh, the mortar is incredibly real. The absolute most crucial point of this entire explainer is this single number, 6%. Let me say that again, 6%. Kimberly-Clark delivered a massive 6% gross productivity savings in the quarter. And listen to me, this isn't a one-off anomaly. This perfectly matches the annual rate they have successfully hit for the last 2 years running, and they are fully on track to do it again for the full year 2026. This is exactly how you generate operational leverage. They are utilizing scalable automation. They are standardizing product platforms globally to heavily reduce manufacturing complexity, and they are optimizing their entire supply chain footprint. Plus, they slashed their overhead rates by 90 basis points down to 13%. What does that mean for you? It means every single dollar of revenue is now flowing much more efficiently straight to the bottom line. They are ruthlessly efficient right now. Section 1. Cracks in the armor. Probing the macro headwinds. Okay. Look, the internal metrics look highly disciplined. I'll absolutely give you that. But a fortress is only as strong as its ability to withstand a siege from the outside. So let's pivot for a second and aggressively probe the external vulnerabilities threatening Kimberly-Clark right now. Because when we start looking at the macro environment, I am seeing some very serious structural cracks. Let's start with a literal fire. In April, a massive fire ripped through a third-party distribution center out in California that was operated for Kimberly-Clark. Management stated directly that this is going to result in an expected $20 million top-line headwind in North America for Q2 alone. But far more importantly, it's going to hit their operating profit by roughly $50 million. A $50 million operating profit hit isn't just a tiny dent in the armor, it's a structural fracture. That is a sudden, unexpected shock to the system that proves no matter how much you optimize your internal supply chain, you are still completely and utterly at the mercy of physical world disasters. It's a setback, yes, absolutely, but they have the massive inventory network required to pivot around this, and they fully expect to recover those losses in the back half of the year. While here is a massive macroeconomic shock they might not be able to easily pivot away from. On the recent earnings call, the CFO was pressed incredibly hard by analysts on commodity risks, and they revealed that if oil stays elevated at $100 per barrel, they are facing an incremental $150 million to $170 million in gross input cost inflation in the second half of the year alone, and that is entirely outside of their current guidance. Think about how a commodity supercycle absolutely destroys consumer packaged goods margins. Think about it. Resins for diapers, plastics for packaging, transportation fuels, factory energy, literally all of it runs on oil. If this inflation actually hits, that 6% margin buffer you love so much is going to evaporate into fuel surcharges and raw resin costs almost overnight. They will be forced to try and push huge price hikes onto a consumer base that is already completely tapped out. Section 2. The heavy lifting. Restructuring for generational value. See, that specific inflation threat is exactly why management isn't just sitting still and hoping the macro winds magically blow in their favor. Kimberly-Clark is actively, aggressively reinforcing its structural integrity. They aren't just selling tissues and diapers anymore. They are fundamentally restructuring the entire corporation from the ground up. The blueprint here is their new fast and agile operating model. They are totally reorganizing the business to focus exclusively on the core areas with the highest margins and the absolute best demographic growth profiles. We're talking baby care, women's health, and active aging. Think about it. Active aging and specialized women's health products command a massive price premium compared to standard commercial paper towels. They are completely pivoting away from being a slow-moving paper conglomerate and leaning incredibly hard into specialized consumer health and wellness. And here is the M&A heavy lifting that makes this massive tectonic shift even possible. Step 1, they are spinning off their international family care and professional business, which is the lower margin commercial tissue segment, into a joint venture with Suzano. Suzano is buying 51% of it for $1.7 billion in raw cash. Step 2, they're taking that massive liquidity injection and using it to help fund an absolute monster of an acquisition. They're buying Kenvue. This is a transformative deal involving $6.7 billion in cash plus 280 million shares of Kimberly-Clark stock. They're literally trading away low-growth commercial paper to acquire iconic, incredibly high-margin consumer health brands that already have massive global reach. It's a bold architectural plan, I'll admit that, but the execution risk here is completely off the charts. You are talking about integrating over 40 distinct global teams. They are trying to manage a $6.7 billion cash outflow while their existing long-term debt is already sitting incredibly heavy at $7.1 billion. How does that affect their leverage ratios? If this Kenvue integration stumbles even slightly, or if the synergy targets are missed by just a fraction, that debt load is going to absolutely crush their margins, and this whole newly constructed fortress could easily come crashing down on top of them. I hear your skepticism on the execution risk, I really do. But just look at the execution on the ground right now. It is practically flawless. Look at the market share data. In North America, 95% of their priority sales-weighted categories are actively gaining or holding market share. That is up from just 32% back in 2023. That is a massive turnaround. Internationally, 84% of their key sales are gaining or holding. They are aggressively winning with the consumer on a global scale. And here is the absolute kicker. Their promotional intensity in North America is actually below pre-COVID levels. Do you know what that actually means for a portfolio? It means they aren't relying on heavy coupons and desperate price slashing to maintain their volume. They have real, undeniable brand pricing power, and they are winning massive market share through superior product innovation, not through desperate discounts. And that market share dominance flows directly into their 2026 financial blueprint. They are projecting roughly 2.5% organic sales growth, which is entirely volume plus mix-led. They expect mid to high single-digit adjusted operating profit growth and double-digit adjusted EPS growth from continuing operations. But here is the holy grail for an iron financial viewer. This is the ultimate proof of durability, the one metric that cuts through every single piece of macro noise out there, approximately $2 billion in projected free cash flow. Even with ramping up capital expenditures to $1.3 billion to modernize their factories, they are still generating an absolute river of cash. That $2 billion covers the dividend, it easily services the new Kenvue debt, and it funds internal growth all simultaneously. That is ironclad. So let's pull back, look at the mathematical realities, and deliver the final verdict on KMB. The bull case is crystal clear. A broad-based 3% volume plus mix growth proves there is real, sticky demand for their premium innovations, and they clearly have the pricing power to back it up. Furthermore, their relentless 6% gross productivity savings act as a massive structural shock absorber, allowing them to expand their operating margins even while investing heavily in the business and fighting off inflation. In the bear case, the skeptic's view remains hyper-focused on those looming macro threats and the massive execution risk. Yes, the productivity metrics are great right now, but a $170 million oil inflation shock will test that margin buffer to its absolute limits. And let's not forget, the Kenvue acquisition remains the ultimate test of management's competence. M&A at this colossal scale destroys shareholder value just as often as it creates it. If they drop the ball in integrating Kenvue, that massive debt load will suddenly feel very, very heavy. Ultimately, it all comes down to your individual risk tolerance and your belief in management's ability to execute this grand generational design. They undeniably have the cash flow, they are securing the market share, and they have the productivity engine firing on all cylinders. But the macro environment is historically unforgiving right now, and the Kenvue deal is a massive, highly leveraged bet on the future. So we leave it to you, the focused learner. Based on the hard data we've walked through today, are you forging Kimberly-Clark into the core foundation of your portfolio to weather the coming storm? Or are the heavy execution risks and looming inflation threats keeping you sitting safely on the sidelines? Evaluate your own portfolio structural integrity, weigh the risks against the cash flow, and make your move. Thanks for joining us on this deep dive and letting us help you cut through the noise. Stay disciplined, stay analytical, and we'll see you on the next Iron Financial Update.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.